All right, let's talk about one of the most powerful concepts in crypto trading, but one that a lot of people get wrong. We're going to be cracking the code on fair value gaps. Let's dive right in.
So, here's the game plan. We'll start with what these gaps actually are. Think of them like secret footprints. Then, we'll get practical and show you how to find them on your chart. After that, it's all about the playbook, how to trade them. We'll wrap up by talking about trading smarter, not harder, and I'll give you a toolkit and the big takeaway.
Okay, let's get into it. Section 1, Smart Money's Secret Footprint. This is where it all starts, right? We're basically learning to follow the trail left behind by the really big players in the market.
You know that feeling? You're just watching a chart, minding your own business, and then bam, a massive price spike just explodes out of nowhere. Ever seen that? Well, I'm here to tell you, you're not crazy. And it is not random. That big, sudden move, that wasn't just noise. It was a footprint, a big one, left by what we call smart money. You know, the huge institutional players. They move with so much force and speed that they literally leave clues behind for us to find. And that clue, that's what we call a fair value gap, or FVG for short. It's basically a three-candle pattern that screams imbalance. Think about it. A huge player dumps a massive order so fast that the market just skips. It leaves this void, this inefficient little zone. And that zone, it often acts like a magnet, just waiting to pull the price back in.
Okay, so that's the what, which naturally brings us to the how. Section 2, Finding Gaps on the Chart. Now that we know what these footprints look like in theory, let's figure out how to actually spot them in the wild.
Believe it or not, the pattern itself is super simple. It's all about three candles. For a bullish FVG, you're looking at the gap between the top of candle 1 and the bottom of candle 3. And for a bearish one, you guessed it, just flip it. The gap between the bottom of candle 1 and the top of candle 3. That middle candle, that's the powerhouse. That's the big aggressive move that leaves the gap behind. And here's the thing, crypto is an absolute hotspot for FVGs. Why? Well, you've got insane volatility, right? That creates those fast moves. The market's open 24/7, so there are always chances for them to pop up. And with more and more big money, institutional money coming in, we're just seeing more and more of these footprints all over the place.
What's really cool is that this isn't just for one type of trader. You can find these gaps everywhere. If you're a long-term trader, you'll see them on the daily chart. If you're in and out fast, check the 5-minute. But for a lot of swing traders, that 4-hour and 1-hour time frame, that's kind of the sweet spot.
Right, so we know what they are, we know where to find them. Now for the million-dollar question, how do we actually trade them? Let's dive into the FVG trading playbook.
Okay, the main strategy here is actually pretty straightforward. Remember how we said the gaps are inefficient? Well, the market hates that. It has this natural tendency to go back and fill that gap to restore balance. And our job, it's just to be ready for that gap fill.
So let's walk through a bullish play. Step 1, you spot that bullish FVG after a big push-up. Step 2, and this is key, you wait. You wait patiently for the price to pull back into that gap. Step 3, you watch for clues that the buyers are coming back. And once you get that confirmation, step 4, that's when you enter your long.
And for a bearish setup, it's the exact same logic, just flipped upside down. You find the bearish FVG after a nosedive. You wait for a little bounce back up into that gap. You look for signs the sellers are taking charge again, and then you hit that short button, aiming for lower lows.
Okay, this next section is absolutely crucial. Trading smarter, not harder. Because look, anyone can learn a pattern, but it's the execution, the discipline, that's what really makes the difference.
So, this leads to a big question. Should you just trade every single gap you see on the chart? Let me be super clear. Absolutely not. All gaps are not created equal. And honestly, learning to tell the good ones from the bad ones is what separates the profitable traders from everyone else.
So here's your filter. This is how you spot the A-plus setups. High priority gaps, they show up at market extremes, highs or lows. They have big volume behind them. And here's the most important part. They break market structure. They take out a previous swing high or low. The bad ones, they're just kind of stuck in the middle of a messy range. Low volume, forget about those. It's all about quality.
And listen, even with the perfect setup, if your risk management is garbage, none of this matters. So these rules, they're non-negotiable. Seriously, only risk 1 to 2% of your account, period. Put your stop loss just outside the FVG zone. Give it some breathing room. And always aim for at least a 2-to-1 risk-to-reward ratio. Your winners have to be bigger than your losers.
Let's just call out the two biggest mistakes people make so you can avoid them. Mistake number 1, trading every single gap they see. The solution? Be picky. Use that priority checklist we just talked about. Mistake number 2, ignoring the overall trend. Come on, you have to look at the higher time frames first. Make sure you're trading with the big money, not fighting it.
All right, we're heading into the home stretch. Let's talk about your toolkit and the one big idea I really want you to take away from all this. Now, the good news. You don't have to sit there with your eyes glued to the screen hunting for these gaps by hand all day. Seriously, technology is your friend here.
If you use something like TradingView, there are a ton of indicators that will literally find and draw these FVGs on your chart for you. Just search for things like Simple FVG or ICT FVG Detector. They're a huge time saver and can help you catch setups you might have missed.
But look, if you remember just one thing from our time together, please let it be this. The goal is not to trade every gap. The goal is to trade the right gaps. It's not about quantity, it is 100% about quality.
You know, there's a quote from the source material that just hits the nail on the head. It says, "The key to profitable FVG trading lies in quality over quantity, focusing on high probability setups with proper confluence." That's it. That's the whole game right there.
So I'll leave you with a final thought. The market is leaving these footprints all over the place, every single day. You can see them now. The question is, which high-quality gaps are you going to choose to follow?